Understanding profitability in cost and financial accounting is a topic that often gets lost in the shuffle of business discussions, yet it's crucial for anyone involved in the financial aspects of a company. So, let's break it down in a way that's engaging, relatable, and informative. First off, let's talk about the fundamental difference between cost accounting and financial accounting. When we think about profit, it's essential to realize that these two accounting methods approach profit from different angles. In cost accounting, profit is calculated as the difference between total revenue and total costs. This means cost accounting digs deep into the nitty-gritty of what it costs to produce a product or service. Think about raw materials, labor, overhead, and even shipping costs. All of these factors contribute to the overall cost of a product, and thus, the profit figure that cost accounting provides can be incredibly detailed and specific. On the flip side, financial accounting takes a broader view. It focuses on net income, which is calculated by subtracting total expenses from total revenue. Here's where it gets interesting. Financial accounting often doesn't consider all the costs that cost accounting does. It tends to focus more on direct costs, leaving out indirect costs like overhead. So, when you see profit figures from financial accounting, they might not tell the whole story of a company's profitability. Now, why does this matter? Well, it can lead to different profit figures depending on which accounting method you're looking at. And this is critical for decision makers. If you're a manager trying to decide where to allocate resources, the profit number you're looking at can significantly influence your decisions. If you're only looking at financial accounting figures, you might miss out on important cost details that could help you optimize profitability. Another key difference lies in how inventory is valued. Cost accounting might use methods like FIFO, first in, first out, where the oldest inventory costs are used first when calculating profit. In contrast, financial accounting might use LIFO, last in, first out, resulting in different profit figures. This difference in inventory valuation can significantly impact the reported profitability of a business, especially in times of fluctuating prices. Timeframes also play a role. Cost accounting often looks at shorter timeframes, like a single production cycle, while financial accounting typically assesses performance over a longer period, such as a fiscal year. This can lead to discrepancies in how profit is reported and understood. For example, a product might be profitable in the short term, but not in the long term, or vice versa. So, when we consider whether the profit calculation from cost accounting is more meaningful than that from financial accounting, it's a nuanced question. Cost accounting provides a more granular view of profitability, which can be incredibly useful for identifying areas for improvement. It gives managers insights into where costs can be reduced and how different pricing strategies might affect overall profitability. However, the downside is that tracking all those costs can be time-consuming and complex, which might not be practical for smaller businesses. Financial accounting, while less detailed, offers a straightforward approach that's generally easier to implement. It's often required by law, providing a level of assurance to investors and stakeholders that the numbers are accurate and compliant with regulations. Investors often rely on financial accounting because it presents a more conservative view of profit, which can be comforting in a world where financial decisions can be fraught with uncertainty. Now, let's talk about the primary users of profitability information. Who's really benefiting from all this data? Managers are typically the primary users. They need this information to make critical decisions about pricing, product mix, and resource allocation. But it doesn't stop there. Analysts and investors also turn to profitability information to evaluate a company's performance and make investment decisions. When managers have access to profitability insights, they can better understand where their company is excelling and where it might need improvement. This information can guide them in focusing their resources effectively, ultimately leading to increased sales and reduced costs. For example, if a manager sees that a particular product line has a low profit margin, they might decide to either adjust the pricing strategy or discontinue the product altogether. So, how often are these profit calculations and insights shared with decision makers? It varies from company to company, but many organizations provide this information regularly, often daily or weekly. This frequency allows managers to stay on top of their financial performance and make informed decisions in real time. Periodic reports are also shared with shareholders and stakeholders, typically on a quarterly or annual basis. But here's the kicker. Can managers run an organization effectively without regular profit insights? It's a tricky question. In industries with slim profit margins, having up-to-date financial information is crucial. A small misstep could lead to significant losses. However, in industries with higher profit margins, there might be a bit more leeway. The size of the organization also plays a role in this equation. Larger companies usually have the resources to track their finances meticulously, while smaller companies might have to rely on less formal methods to understand their financial situation. And then there are the specific goals of the organization. If a company is aiming for aggressive growth or market expansion, regular insights into profitability are essential. On the other hand, if the goal is to maintain the status quo, the urgency might not be as high. Now, who is responsible for calculating profitability? Typically, this falls to the finance or accounting department. These professionals have the expertise in financial concepts and accounting principles necessary to ensure accurate calculations. If you're unsure who handles this in your organization, it's best to ask a supervisor or senior manager for guidance. When it comes to sharing profitability information, there are several common methods. The most prevalent is through financial statements, which provide a comprehensive overview of a company's profitability over a specific period. These statements usually include an income statement, balance sheet, and cash flow statement. Additionally, profitability can be reflected in a company's share price. If a company's share price is on the rise, it's a strong indicator that investors believe the company is performing well. To wrap this up, understanding how profit is shown differently in cost accounting versus financial accounting is vital for anyone involved in business decision-making. Both accounting methods have their strengths and weaknesses, and it's crucial to use them in tandem to get a complete picture of a company's financial health. Cost accounting offers a detailed look at profitability, which can be incredibly useful for internal decision-making, while financial accounting provides a broader perspective that's essential for external stakeholders. So, the next time you're looking at profit figures, remember that the numbers can tell different stories depending on the accounting method used. Understanding these nuances can make all the difference in how you approach your business decisions.